So in the part 1 of the fundamental analysis of stocks video, we had looked at some of the important ratios and parameters that we need to consider before investing our money in any of the stock. In this video, we will look at some more of these parameters that we just cannot afford to ignore while buying a stock of any of the company. And if you have not yet watched the previous video of this series, I have provided a link to that video in the description of this video. I would request you to check that video out once you are done with this one. So without wasting any further time, let's get straight into today's video. So number one parameter is return on assets, which is ROA. Return on assets measures a company's ability to generate income from its assets. ROA is also expressed as a percentage, and this financial ratio indicates how much profit can be derived from each rupee of assets owned by the company. Now, the assets for a company can vary from industry to industry. For example, a vehicle company like Tata Motors, its most important assets would be the manufacturing factory or the machinery. But an IT company like TCS, its most important assets would be the talented people that are working in it instead of the computers or the laptops. You can calculate ROA by dividing net income by total assets, then multiplying that number by 100. In general, an ROA above 5% is considered to be good. A higher ROA is better as it indicates that the company can generate more income from each rupee of assets. For example, here we can see the return on assets of HUL is 14.2%, which can be considered as a decent number. Parameter number 2 is earnings per share or EPS. EPS is a profitability indicator, and it's just one of the several ratios that can be used to gauge a company's financial health. Earnings per share is the amount of net income you can make per share of a stock within a given time period. In other words, it defines how well a stock is performing in the current market. To find the EPS, you would simply divide a company's reported net income after tax minus its preferred stock dividends by its outstanding shares of stock. So actually there is no hard and fast number to define a good EPS across companies, since there are so many factors that go into a company's net income and stock price. But generally, companies with increasing earnings per share for the last couple of years can be considered as a healthy sign. For example, here we can see that the EPS of ICICI Bank is on the rising side since past few years. So the next ratio is the quick ratio. It is also known as the acid test ratio. The quick ratio measures a company's immediate ability to cover its current liabilities with its most liquid assets. For example, cash equivalents, marketable securities, account receivable, etc. The quick ratio doesn't consider inventory as current assets, as it assumes that selling inventory will take some time and hence cannot meet the current liabilities. Expressed as a numerical value, it is calculated by dividing liquid assets by current liabilities. A value of quick above 1 indicates that the company can immediately pay off its current liabilities using its liquid assets, while a value below 1 indicates that it cannot. For example, here we can see that the quick ratio of ICICI Bank is 2.20, which is a healthy sign. Parameter number 4 is price earnings to growth ratio, which is PEG ratio. PEG ratio or price earnings to growth ratio is used to find the value of a stock taking into consideration the company's earnings growth. This ratio is considered to be the more useful than the PE ratio, as the PE ratio completely ignores the company's growth rate. The PEG ratio is calculated by dividing the PE ratio by the expected growth of the company's earnings per share. In general, a value below 1 may indicate that the stock is undervalued, whereas a value above 1 may indicate that it is overvalued. For example, here we can see that the PEG ratio of HUL is 3.96, which according to the PEG ratio is overvalued. Next ratio is price to book ratio or the PB ratio. The price to book ratio is a measure of company's share price in relation to its book value, which in other words indicates that the price investors must pay for each rupee of the book value. Like the price to earning ratio, this relative metric is better suited for comparison against other companies or industries. Price to book ratio is calculated by dividing the company's current share price by its book value per share. A lower value can indicate that the stock is underpriced, whereas a higher value may indicate that the stock is overpriced. Price to book ratios vary between industries, making it difficult to set a benchmark for what makes a good price to book ratio. However, if the value falls below the industry average, it may indicate that the stock is undervalued. If the value is above the industry average, it may indicate that the stock is overvalued. For example, here we can see that the PB ratio of HUL is 11.6 as compared to the industry PB ratio of 30.9. Ratio number 6 is interest coverage ratio. Interest coverage ratio measures a company's ability to pay the interest on its debt. Since interest coverage ratio helps lenders and creditors gauge the level of risk involved in lending, hence it is very important ratio for financial analysis. The interest coverage ratio is calculated by dividing the company's EBIT by its interest expense. Here, EBIT means company's earning before interest and taxes. A value above 1 indicates that a company's EBIT can cover its interest payments, whereas a value below 1 indicates that it cannot. A higher number is better because it reflects a greater ability to repay the debt. For example, here we can see that the interest coverage ratio of ITC is 612, which is extraordinary. And finally, as a bonus tip, I would suggest you guys to have a look at the promoter holding of the company's share that you are considering to invest. This actually doesn't come under the fundamental analysis, but it is definitely worth having a look at as it indicates the promoter's conviction in their own company. Generally, it should be at least 50% or higher, but there are some exceptions to this. For example, here we can see that the promoter holding of Infosys Limited is just around 15%, but this does not make it a bad company at all. Also, increasing or constant trend in promoter holding can be a positive sign which shows promoters' faith in the company, while a decreasing trend in the promoter holding can be a red flag. So in conclusion, we can say that the ratios or factors discussed in today's video can be considered as guidelines before investing in a company's share and not the ultimate truth, because we need to take the context into account while applying them to any company, such as the industry it belongs to, the customer base it serves, the government policies for that sector, and many more. But with the use of these factors, at least we will be on a right path to select a stock on our own instead of buying them on tips or news or social media advice. So that's it for today's video, guys. I hope you guys found this video useful and learned something new about selecting a stock before we invest our money. Please do check out the part 1 of Fundamental Analysis series and do not forget to like, share and subscribe to the channel. I will meet you in the next video. Till then, take care.